Today I'm going to talk about Singapore savings bonds, which have been very popular in the past few months because of the high interest rates, and some of the downsides of SSBs, as well as how we can go about managing the problems of Singapore savings bonds. Now, don't get me wrong, SSB is a good place for you to put some excess funds, and the latest issue even gives up to 3.21% per annum interest for 10 years. So it's a very good place for you to put aside some funds that you're not using, but it does come with some downsides, and I'll elaborate them in this video. Now, some of the downsides are more obvious than others, and let's start with the obvious ones. I think everybody knows that Singapore savings bonds have been oversubscribed in the past few months because of the high interest rate as well as the popularity, and everybody now knows that Singapore savings bond is a great place to put your funds. So if you look at the allotment data from the past few months, you realize that when the interest rates are high, the ceiling amount will be very, very low, such as in August 2022, SSB, the ceiling amount was only $9,000. So if you place anything above this, you will not get more than $9,000 plus $500 for additional allotment. And only 8% of applicants got the extra $500, which again is a very small amount. Last month's bond, the October 2022 SSB, was not very popular, and the ceiling amount was quite high at $42,000. But this month's November 2022 SSB is likely going to be very, very oversubscribed, because if you look at the total tranche amount, it's only 900 million compared to August, which was 700 million. And therefore, there's only a little increase in the tranche size, but the interest rates are much higher this time round, right? Even first year exceeds 3% per annum interest rate. So you can expect this to be super oversubscribed. The flexibility of SSBs also mean that people can actually withdraw savings from older SSBs and then put into new ones when interest rates go up. And there are people who have been refinancing their SSBs like that. So you can expect that this month's SSB will be very, very oversubscribed. And I'm predicting maybe about $5,000 or $6,000 in ceiling amount. So the low ceiling amount is going to be an issue for people with larger amounts of money to place, because let's say you have $100,000 or even like $50,000, you'll find it quite difficult to put a meaningful amount into SSBs, and meanwhile your funds are just sitting in your bank, maybe generating whatever your bank interest is giving you, which luckily has been on the rise as well, but nowhere near what SSB gives. So yeah, for people with larger amounts of money, the low ceiling amount is an issue. So people with larger amounts of money can actually look at my video on the alternatives to SSBs, and you get some ideas on where to put funds that you can't place in SSB because of the low ceiling amount. Now, of course, you can place your funds slowly over the next few months, and some people have indeed been doing that. They have been putting 10, 20k each month into SSB, creating an SSB ladder of sort. It also means that if you have older SSBs to refinance, you should probably think twice, because you might not get as much as you originally had. So yeah, do take note that this month's ceiling amount can be quite a lot lower than what you placed in SSB previously. Now, this video is brought to you by Weeboo, and you can use my link satisfy.com/Weeboo to sign up and get yourself fantastic goodies such as free shares. Weeboo also currently gives you 0% commission, as well as let you trade from as low as $5 per trade, and therefore you can lower your cost by a lot and trade with small amounts. And you get free shares to kickstart your investment journey. So I really thank Weeboo for sponsoring this video, because without sponsors like this, I don't think I will be that hardworking in making videos. Thanks Weeboo again for sponsoring this video. Another reason why SSBs are very popular is because they are fairly liquid, and you can actually withdraw them without actually having to hold them for years and years like some other products. But they are not as liquid as bank accounts, obviously, and you can only make withdrawals once a month. And any withdrawal is subject to the redemption timeline. So if you submit a withdrawal request now, you have to wait until the start of next month to take it, and therefore your waiting time is at least 3 weeks or so. If you make a redemption request nearer to the end of the month, you obviously will wait less, about a week. But if you miss the deadline, then you have to wait an entire month, because the cutoff for this month, for example, is 26 October 9 p.m. And if you miss this deadline, you have to wait until December for the funds to be dispersed to your account. Now, obviously, this isn't as bad as insurance savings products, which totally don't allow you to withdraw, or maybe make you take a policy loan and then pay interest on the amount. But the wait time for the redemption of funds can pose an issue if you are relying on this for emergency purposes. So do not put all your emergency funds into SSBs. In fact, I think you should have at least 2 to 3 months in bank in fully liquid state where you can withdraw anytime you want, and then the rest you put into SSBs, because you really won't know when you require a large sum of money, and SSBs waiting time might be an issue when a real emergency strikes. So while SSB's interest rates can be very attractive, you need to weigh against any potential exigencies that may require large sums of money, and then there is a waiting time for your money to be dispersed. Even though it's just a few weeks, it might be very critical in certain emergencies. I previously mentioned before that you can put about 1 or 2 months of emergency savings in your bank and then the rest in SSBs, but I think you should probably tweak the ratio according to your risk appetite. Maybe 3 to 4 or even 6 months of emergency savings in your bank and then the rest in Singapore savings bonds. So do not put everything into SSBs thinking that they are fully liquid. It is quite liquid, but the few weeks waiting time can be a very, very bad thing if you critically need the money in times of emergencies. Now, SSBs have been giving pretty good interest rates in the recent few months, but do you know that it is not compounded? This is because SSB actually give you return by issuing a coupon every 6 months, and the amount is actually deposited into your bank account. So let's say you invested $10,000 in November 2022's SSB, you actually get $154 in May 2023 and then another $154 in November 2023. And therefore, you are getting the coupon every half a year. The coupon is directly credited to your bank account and therefore it will not enjoy the ongoing interest rate that your savings bond is giving you. And you will have to put your $154 somewhere in order for it to generate a return. So if it's directly credited to your bank account, which earns little to no interest at all, then you're actually not compounding interest on your savings. So if you put $10,000 into Singapore savings bond giving you 3.21% per annum interest, you actually get $3,213 of interest. But if you were actually to compound it at 3.21% per annum interest, you actually expect to get $3,715 of interest. So there is some difference between compounding and non-compounding interest, and therefore you have to make sure that you get some interest on the coupons that you've been receiving from your Singapore savings bonds. Lastly, I think that Singapore savings bond is arguably too conservative for a long time horizon. Now, it depends on your profile, of course. If you're someone who is nearing retirement age and you feel like you are going to put your retirement nest egg into SSBs, I think that's not much of an issue. But if you're a young investor and you have 10, 20, 30 years of time horizon in front of you, why are you putting so much money into SSBs? I think that you should actually be looking at putting your funds into more higher yielding and higher risk instruments instead. Singapore savings bond, while attractive for a conservative product, only gives you around 3% per annum returns, and that is not going to do much to help you accumulate your wealth over a long time period. If you are really planning to put your funds aside for 10 years, don't you think you should put it into equities instead, which are volatile in the short term, yes, but it tends to give you a much better return over a long time horizon. Now, of course, this is not personal financial advice and should not be taken as such. Go and invest according to your risk appetite. But if you really want to set aside funds for 10 years, I will strongly encourage you to take a little bit more risk and look at putting into equities instead. Okay, if you are putting funds into SSB for a short period of time, I think that's perfectly fine because equities in the short term can be very volatile. Just look at the markets lately. I know that Singapore savings bond is 100% safe unless Singapore government collapses, which is very, very unlikely. But I think a big risk is actually not taking risk with your money at all, because we know that inflation is a thing. We know that your value of money erodes year on year, and around 3% per annum return actually does very little to help you accumulate wealth and fight inflation at the same time. So do look at investing more funds into things like equities rather than locking them all up in conservative things like fixed deposits or SSBs or T-bills. I'll be coming up with a webinar for investing in the near future, so subscribe to my Telegram group and YouTube channel if you want to listen to that webinar. And if you want to see alternatives to Singapore savings bond, click on this video that's popping out on your screen right now, and I'll see you in that video.